The median 55-year-old in America has about $80,000 saved for retirement, not the reckless ones. Not the people who bought boats they couldn't afford or took out second mortgages to visit Europe. The median. Half the country is below that number. But here is the thing that should actually alarm you. The people with 300,000, 400,000, even 500,000 saved, most of them are also quietly on track to run out of money. They just will not find out until they are 68, 69, staring at a portfolio statement that is declining faster than they expected, with no compounding window left to fix it. The system did not fail them loudly. It failed them through 4 specific, invisible, mechanical processes that nobody with a financial incentive to explain them ever got around to explaining. This video is about those 4 processes, specifically with numbers, because vague financial dread is not useful. Knowing exactly which hole is draining your tire that is useful. I said tire. Let me come back to that. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link is in the description. Now, the metaphor. Picture a slow puncture. Not a blowout. Blowouts you notice instantly. You pull over, you deal with it. A slow puncture is different. The pressure drops 2 or 3 psi every few weeks. The car drives fine. The steering feels normal. Your quarterly 401k statement arrives, and the number is higher than last quarter, so you feel fine. You keep driving. And one morning, you walk out to the driveway, and the tire is visibly completely flat. Your first thought is, when did that happen? The real answer is, it was always happening. You just could not feel it. That is your retirement savings between the ages of 30 and 55. The pressure bleeds out slowly, invisibly, through fees, through inflation math, through a risk most people have never heard of, and through a healthcare number that will make you momentarily not want to finish this video. But stay with me, because the tire does not have to go flat. The point of knowing where the holes are is that you can patch them. I'm going to show you all 4 holes and give you 3 specific things to do about them, not generic things. The specific, boring, actually effective things. Let me start with the hole that almost nobody talks about. In a few minutes, I will show you the fee math, and that number is going to be the one that sits with you after this video ends. But first, I need you to understand something called sequence of returns risk, because this is the concept that separates people who retire comfortably from people who technically had enough money until they suddenly didn't. 2 people. Call them Alan and Bob. Same age, 65. Same portfolio, $500,000. Same plan, withdraw $20,000 per year, roughly the amount that supplements their Social Security income to a livable level. Same fund, a diversified equity portfolio that over the next 30 years will average exactly 7% annually. Same average, same everything, except one thing. Alan retires in a bull market year. His first 5 years of returns look like this: 9%, 12%, 14%, 8%, 11%. The portfolio grows while he withdraws from it. By year 5, despite pulling $20,000 per year out, his balance is higher than when he started. Bob retires in a bear market year. His first 3 years, negative 22%, negative 15%, negative 9%. His portfolio has lost roughly 40% of its value in 36 months. And Bob is still withdrawing $20,000 every year to pay his bills because his mortgage does not care what the S&P 500 is doing. He is not selling equities because he wants to. He is selling because he has to eat. And those shares sold at the bottom of a downturn are permanently gone. They cannot recover for him because he no longer owns them. When the market rebounds in years 4 and 5, Bob has significantly fewer shares to benefit from that recovery. Now fast forward 30 years. Same average annual return, same starting balance, same withdrawal rate. Alan finishes with approximately $1.2 million. Bob runs out of money entirely at age 81, 14 years earlier. Not because he was less disciplined, not because he made worse investment decisions, because of what the market did in the first 36 months of his retirement, something he had zero control over. This is the first hole in the tire. And here is the reversal I want to deliver directly. You think the retirement problem is about how much you save. Every piece of mainstream financial advice is aimed at that message. Max your 401k, increase your savings rate, automate your contributions. That advice is not wrong, but it is incomplete to the point of being dangerously misleading, because the timing of when the market has a bad year relative to when you retire is a variable with enormous consequences, and it receives almost no coverage in the standard retirement planning conversation. You can save perfectly for 30 years and still run out of money because you retired into the wrong 3-year window. I watched this happen to a man I will call Marcus. Real situation, change name. He spent 28 years as a logistics manager. Not glamorous, but steady. He contributed to his employer plan consistently, owned his home, carried no meaningful consumer debt. By late 2007, at 64 years old, he had about $650,000 saved. He retired, had a small party, felt good, had earned it. You know what came next? The 2008 financial crisis cut his portfolio by approximately 40%. $650,000 became roughly $390,000. And because Marcus was no longer working, he had to draw $25,000 per year from that depleted number to cover his living costs. He was selling equities at their lowest prices to fund groceries and utilities and a mortgage he was still paying off. The market recovered in 2010, 2011. The recovery was real, but Marcus had sold so many shares at the bottom that his recovery was permanently truncated. He owned far fewer shares to benefit from the rebound than he had when the crisis began. By 2013, Marcus had less saved than he had at 60 years old. He went back to work part-time at 68. Not because retirement bored him, because the tire had gone flat and he had no spare. Marcus did everything right. He had one bad exit window. That is the slow puncture nobody showed him. Now, the solution to this specific problem has existed for decades. It is called the bucket strategy, or more formally, liability matching. You structure your retirement assets into 3 distinct buckets before you retire. Bucket 1 is 1 to 3 years of living expenses, sitting in cash, or very short-term treasury securities. This is what you live on. You never sell equities to fund daily life, especially not during a downturn. Bucket 2 is 3 to 10 years of moderate growth assets, balance funds, shorter duration bonds, anything that is not equity volatile in the short term. Bucket 3 is your long-term equity portfolio. You do not touch it for at least a decade. When the market crashes in year 1 of your retirement, you live off bucket 1. The equities in bucket 3 have time to recover. You refill bucket 1 from bucket 2 when the storm passes. This is not complicated. William Bernstein wrote about it. Vanguard uses elements of it in its own research. Christine Benz at Morningstar has published extensively on it. The backtesting is extensive. And yet, look at the default options in your employer-sponsored retirement plan. There is no bucket structure. There is a target date fund. There is a smooth line projected to go up and to the right. And there is an expense ratio quietly draining pressure from the tire every single year. Which brings me to the second hole. And this is the one where I want you to actually write down a number. If you have $200,000 invested today and earn an average of 7% per year over 30 years, you end up with roughly $1,522,000. No fees, just compounding. Now add an annual expense ratio of 1.2%, not an extreme number. That is the average expense ratio for actively managed mutual funds inside employer retirement plans, and your net return drops to 5.8%. Same 30 years, same starting amount. You end up with approximately $1,148,000. The difference is $374,000. Nearly $374,000 paid to a fund manager for the privilege of statistically underperforming a basic index fund. According to the S&P SPIVA report, which tracks active fund performance against benchmarks every 6 months, roughly 79% of large cap actively managed funds underperform the S&P 500 over a 15-year period. Not occasionally, structurally, consistently. The fee is a mathematical headwind that compounds in the wrong direction for as long as you hold the fund. By the way, hit subscribe if you like what you're hearing, because YouTube's algorithm may actually never show you my videos again if you don't. I have a complicated relationship with the algorithm. We are working through it. Here's the thing about why people stay in high-fee funds. It is not stupidity. It is the same reason people keep a gym membership they do not use. Staying requires nothing. Leaving requires a conscious decision. The default allocation in your 401k is not the cheapest option available. It is the option that was easiest for the plan administrator to put in place, and in many cases, the fund company paid for that placement. This is a real practice called revenue sharing. It is legal, and it means that the fund sitting in your retirement account right now is not necessarily there because someone analyzed it against every alternative and decided it was best for you. It is there because somebody got paid to put it there. Your financial advisor, meanwhile, may not be legally required to flag any of this. The fiduciary standard, the rule that requires advisors to act in your best interest, applies to some advisors and not others. An advisor operating under the looser suitability standard only needs to recommend something suitable, not optimal, not cheapest, not mathematically best for your specific situation. Suitable, which is a bar set approximately as high as you would expect it to be given who lobbied to keep it that low. This is not a conspiracy. I want to be precise about that. The financial services industry is not populated by villains. It is populated by people responding rationally to incentive structures. The advisor earns more when you are in a higher fee product. So the path of least resistance, and often the most marketed path, is higher fee products. This is as surprising as discovering that a casino is architecturally designed to make you lose track of time. The tire has two holes now: sequence risk and fee drag. Each is manageable in isolation. Together, they have quietly destroyed the retirement plans of an enormous number of people who saved responsibly and assumed the system was working in their favor. But stay with me, because this next part changes everything. The inflation math, and specifically the gap between what people think their retirement will cost and what it will actually cost, is the third hole. And it is subtle in a way the other two are not. 3% annual inflation does not sound alarming. But here is what 3% does compounded over time. At 3% annually, prices double in roughly 24 years. So if you retire at 65 and you are planning to live to 90, which is not an unrealistic planning horizon for someone in reasonable health, the lifestyle that costs $60,000 per year at 65 will cost approximately $120,000 per year at 89. Not because you upgraded your lifestyle, because the dollar got weaker while you were watching. And here is the specific version of this math that most people have never calculated for themselves. The 4% withdrawal rule, the classic retirement planning heuristic, developed by financial researcher William Bengen based on historical data through 1994, says you can withdraw 4% of your portfolio annually, and it will, in historical simulations, last 30 years. Morningstar's updated 2023 research suggests that in the current interest rate and valuation environment, a more realistic safe withdrawal rate is closer to 3.3%. That does not sound like much of a difference. But on a $500,000 portfolio, the difference between 4% and 3.3% is $3,500 per year in sustainable income. Over 20 years, that is $70,000 your original plan assumed you had. But the updated math says you probably don't. There is a joke inside every financial planning office in America, and it goes something like this. The advisor pulls up the projection. The line goes smoothly up and to the right. The client says, "So I'm going to be fine?" The advisor says, "Based on our assumptions." The client says, "Great." Nobody asks what the assumptions are. Because the assumptions are constant returns, no bad sequences, inflation running exactly at target, and that the client dies at a statistically convenient age. The model is beautiful, as long as nothing unexpected ever happens. Which is funny, given that the entire purpose of a financial plan is to handle the unexpected, and then there is Social Security. which most people count on as the inflation hedge in their retirement plan. The cost of living adjustments to Social Security are calculated using the Consumer Price Index for urban wage earners and clerical workers. But retirees do not spend money like urban wage earners. Retirees spend a substantially larger proportion of their income on healthcare and housing, both of which inflate faster than the general CPI. The Senior Citizens League has tracked this discrepancy and found that Social Security benefits lost roughly 36% of their purchasing power between 2000 and 2023, even with the annual adjustments included. Your Social Security check went up every single year and still bought 36% less in real terms over that period. Everyone technically knows that Social Security was designed to supplement retirement income, not replace it. And yet the average retirement plan I have looked at, both my own and those of people I know, is asking Social Security to carry far more weight than it was ever structurally designed to carry. That is 3 holes now: sequence risk, fee drag, inflation erosion. And I promised you the kicker. This next one is the one that makes the spare tire also flat: healthcare. Fidelity's 2024 estimate for out-of-pocket healthcare costs for a 65-year-old couple retiring today is $315,000 over the course of retirement. That is after Medicare. That is not counting long-term care. That is baseline, boring healthcare. Premiums, deductibles, prescriptions, dental, vision, hearing. The unavoidable costs of an aging body in a country where medical inflation has run at approximately 5 to 6% annually for 2 decades. But the number that does not get enough attention is the gap year cost. If you want to retire before 65, and Gallup surveys consistently show most Americans want to retire between 60 and 62, you lose employer-sponsored health insurance, and Medicare does not begin until 65. For a couple in their late 50s in 2026, a comprehensive private health plan runs between $22,000 and $30,000 per year in premiums alone. Before anything goes wrong medically, before deductibles, before prescriptions, $22,000 to $30,000 annually, at the exact moment you have stopped generating income and started drawing down savings. This is the structural reason the actual median retirement age in America is 62, despite most people wanting to leave sooner. The 3-year healthcare gap keeps people employed not because they love their jobs, but because the cost of leaving is a number that looks like a car payment plus a mortgage payment combined and recurs every month. Marcus, the logistics manager from 2007, had one more chapter. At age 67, his wife had a cardiac event. Not immediately life-threatening, but it required hospitalization, a procedure, and extended follow-up care. Their out-of-pocket costs for that year were approximately $18,000. Not a catastrophic number in isolation, but added to a portfolio already depleted by the 2008 drawdown, already grinding through annual withdrawals with insufficient recovery. It was the event that pushed their annual depletion rate into permanently dangerous territory. It was not the stock market that ultimately broke Marcus's retirement plan. It was a medical bill, a predictable, statistically inevitable medical bill that the original plan had not modeled at all, because the plan's smooth upward line had no room for a human body in it. Marcus is okay for what it is worth. He downsized significantly. He went back to part-time work. He and his wife get by, but getting by was not the plan. Getting by is what you end up with when the tire goes flat 4 separate times and nobody helped you find the holes in advance. Now, the framework. I said 3 levels, and I meant it. Level 1 is fee surgery. This week, not eventually, open your 401k, your IRA, your brokerage account. Find the expense ratio on every fund you own. Most platforms display it right on the fund profile page. If anything is above 0.2%, you have a live leak. If anything is above 0.5% and it is an actively managed fund, you are almost certainly paying for underperformance while compounding works against you. Vanguard's Total Stock Market Index Fund charges 0.03% annually. Fidelity's Zero Total Market Index Fund charges literally 0. Switching from a 1% expense ratio to a 0.03% expense ratio on a $200,000 portfolio over 25 years is worth approximately $180,000 in recaptured compounding. You do not need to become a trader to capture that gain. You need to open a tab, find the fund, and change the allocation. It will take less time than watching this video took. Level 2 is inflation adjusting your retirement number. Take whatever target number you currently have in your head, $1 million, $1.5 million, whatever the figure is, and run it forward at 3% annually for each year until you plan to retire. Then run your expected annual expenses forward at the same 3%. The gap between your inflation-adjusted expense needs and your portfolio's actual sustainable withdrawal capacity is your real shortfall. Most people set their retirement target once, years ago, based on a conversation with someone at HR or a financial planner who was running an optimistic projection, and they have not revisited it since. The target number sits there, getting more wrong every year, while the balance going up on the statement creates a false sense of security. Level 3 is building the buckets before you need them. You do not have to be 64 to start thinking this way. If you are in your 40s or 50s, and this means keeping 1 to 2 years of living expenses, call it $40,000 to $80,000, depending on your lifestyle in a high-yield savings account or a short-term treasury ladder, separate from your investment accounts, not in equities, accessible within days. This is not dead money. High-yield savings accounts in 2026 are paying approximately 4 to 4.5% annually. You are earning a real return while also buying protection against the exact sequence of return scenario that ended Marcus's retirement on its first day. The bucket is the shock absorber. It is the difference between being Alan and being Bob when the market decides to have a bad year the same month you stop working. Let me give you one concrete scenario so this stops being abstract. Janet, 48 years old, healthcare administrator in Columbus, Ohio, $75,000 per year, has $160,000 in her 401k. She set her contribution allocation in 2014 when she first enrolled and has not looked at it since. She does not know what her expense ratios are. She checks her balance periodically, sees it going up, and assumes this means everything is fine. Janet's current fund mix averages about 0.9% in annual fees. If she switched entirely to the lowest cost option available in her plan, and there is almost certainly a low cost index option there, because federal rules now require plans to offer them, she could cut that to approximately 0.2%. The difference of 0.7% annually on a growing balance over 17 years until her planned retirement adds up to roughly $70,000 in recaptured compounding. $70,000. Just from spending 40 minutes changing a fund selection she made in 2014. Beyond the fees, Janet plans to retire at 65. She currently spends $52,000 per year. At 3% annual inflation over 17 years, her lifestyle will cost approximately $86,000 annually in nominal terms when she retires. If she stays on her current savings trajectory without any changes, she will have about $450,000 saved. A 4% withdrawal gives her $18,000 per year from the portfolio. Her Social Security benefit at 65, 2 years before her full retirement age, meaning a reduced benefit works out to roughly $19,200 annually based on her earnings history. Combined, that is $37,200 per year. She needs $86,000. There is a $49,000 annual gap between what Janet's plan produces and what Janet's life will actually cost. That gap does not get closed by working one extra year. It requires a higher savings rate now, fee reduction, and a genuine conversation about what 65 retirement actually looks like, given the math, versus whether 67, with a slightly adjusted lifestyle, might be the trade that actually works. None of those conversations are difficult. All of them require Janet to look directly at numbers that the system has no incentive to show her clearly. The tire has been losing pressure since 2014. The balance going up on the screen masks the leak. She has 17 years left. The math is fixable, but not if she never finds the holes. Here's the second aside I want to give you, because I think we have earned a moment of absurdist clarity. There's a product called a target date retirement fund. The pitch is elegant. You pick a year, say 2035, and the fund automatically shifts its asset allocation as you approach that date. More equities when you are young, more bonds as you near retirement. Set it and forget it. The fund manages the risk, so you do not have to. Brilliant, right? Except the fund adjusts based on your target date, not your sequence of returns risk. It does not know if the market is going to crater the same quarter you retire. It does not build the three-bucket structure. It does not model your personal healthcare costs or your specific inflation exposure. And it charges, on average, about 15 to 20 basis points more than a simple two-fund portfolio of equivalent index funds. The target date fund is the GPS that always suggests the highway route without ever checking traffic. It will probably get you there. If nothing unexpected happens, which again is a low bar for a product designed to handle unexpected things. I've been running my own business for more than 10 years. I have been in rooms with accountants and tax attorneys who taught me how money actually moves at the institutional level, not in textbooks. In practice, in the specific decisions that get made when the incentives are clear. And the thing I took away from all of those rooms is this: almost every default option in any financial product is designed first for the convenience of the provider and second for the optimization of the investor. The default fund allocation is the one easiest for the plan administrator to justify. The default contribution rate is the one that generates the fewest HR complaints. The default retirement age assumption in every projection tool is the round number that produces the smoothest, most reassuring graph. It is not fraud. It is incentive alignment working exactly as designed. The incentives are just not aligned with your situation. I have multiple hundreds of thousands of dollars invested. Skin in the game, not theory. And every time I run my own numbers, honestly fee adjusted, inflation adjusted, with a realistic healthcare line, I find gaps I did not expect every time. The system does not surface them for me. I have to go looking. So do you. Lazy investing built more fortune than crypto memes. Not because doing nothing is smart, because the lazy, boring, structurally sound version of investing low-cost index funds, inflation-adjusted projections, three-bucket structure, fee surgery done once and then left alone consistently beats the hyperactive version. Vanguard's own research on what they call the advisor's alpha found that behavioral coaching, simply stopping investors from making panic-driven decisions, is worth up to 1.5% in annualized returns. Not from finding better stocks, from not selling in 2008 and missing the recovery in 2009. The value is in not reacting. The value is in having a structure that does not require you to react. The retirement crisis that is quietly building in this country is not primarily a savings crisis. People are saving. The 401k contributions are going in. The balances are rising. The quarterly statements look fine. The slow punctures are doing their work underneath, invisible, for 2 decades. And at 55 or 58, or the morning after the retirement party, the moment the math actually matters, the tire is flat. Not because people failed, because 4 specific, mechanical, calculable forces were working against them the entire time. And nobody with a financial incentive to explain those forces clearly had any particular reason to do so. Now you know what those forces are. You know the name for them. You know the math behind them. You know the 3 things that patch the holes. Find them, patch them, then drive.